You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Welcome to the last edition of 2019 of the Systematic Investor Series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we, in addition to our usual topics, we'll discuss some of the highlights of the last 12 months and how we view the current state of trend following, perhaps. But before we get into all of this, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz. How are you doing?
Hello, gents. How are you?
Doing well. Glad to be on the last podcast of the year and look forward to the 2020.
Yes.
Yeah, absolutely. It's going to be exciting, no doubt. And of course, this was a bit of a quiet week from a market perspective during this holiday season. I think it's kind of the only time of the year where there's one day where none of the markets are open. So it's not much of a market review that I have to offer this week. Of course, last week we did talk about this article from Cliff Asness about how kind of illiquid investments, where you don't have to mark to market, so they also have artificially low volatility. And I think we all think about private equity as a good example of that, how these types of investments perhaps are easier for investors to stick with compared to what we do in the trend following world. But then at the same time this week, I did notice there was a report out from Morningstar who came with the conclusion that higher volatility brings higher returns. And of course, for us in the trend following world, that is no surprise. But what fascinates me still, though, is that many of the investors who really need the higher returns to meet their liability requirements, like underfunded pension funds, etc., they don't really have a meaningful allocation to high vol strategies like trend following. So, of course, I'm sure that the next crisis will change that, but as history has taught us many times, that's usually a little bit too late to come to that realization. But I don't know about you, Moritz. We'll talk about the year as a whole, maybe a little bit later, but I don't know if there's anything this week, not from a performance point of view before you jump into that, but maybe if there were any of the markets that you follow closely that kind of stood out. As I said, on my side, it was kind of the most extreme was up 4% for the markets we trade, and the most extreme to the downside was down 4%, so nothing really too exciting, but you do trade a few different markets than we do, so I was just curious.
Not much stood out. The one market that I remember I had a bit of a look at is gold. Gold was kind of like sitting in the 1450, 1480 or something like that range. I mean, I'm not a technical chart analyst, but I remember it being stuck there for a while. And then all of a sudden, boom, it made a move higher, and we're now again north of the 1500 mark. So those precious metals are looking strong. And, probably completely unrelated, but it happened to coincide with a legislative change here in Germany. So, Germans apparently, they love their gold and they like to hoard physical bullion in their safes or wherever they keep it. And they could, in Germany, you could buy gold, physical gold, I think, without showing an ID, tax-free, up to an amount of 10,000 euros. And in years prior, that amount has been even higher, or maybe even unlimited. And over Christmas, people were, lining up in front of the stores, and they were buying their bullion to give away for presents or keep for themselves. And now this has been lowered to 2,000 euros, which isn't really a lot. I mean, 100 grams of physical gold is about 4,000 euros. So it's really, we're down to, if you want to buy physical gold, you can buy some coins without showing an ID. But if you really want to invest and have a larger allocation to physical gold, then you now become ID'd, and your address and identity is then known to the authorities. And this is effective 31st of December this year. And so we have pictures of all those physical gold stores, and there's like, lines of, hundreds of people queuing so that they can buy their gold. So it's moving higher. There you go. I'm long. I like it.
I mean, it's quite interesting, not from a market point of view, but of course, this trend that you mentioned, Moritz, is something we've seen in Europe. The fact that you're not allowed to carry much cash anymore, that's illegal now. Apparently, you can't buy much gold anymore. I mean, and this has nothing to do with trend following. It has nothing to do with what we normally talk about. This is just a personal observation. I mean, we're certainly heading into a time where it would seem like authorities are very keen on controlling everything to do with cash and money
everything
flows.
You do. They want to know what you own and where you purchased it and when and how much, and tax you on it. Or they want to know that you have it comes the time when they need to confiscate it again. Who knows? We've not we have seen it, not you, I, and Jerry, but my grandparents have seen periods like that, and I only know it from being told that, it can happen. In the US, gold has been illegal. If you had, the possession of physical gold, then you could go to jail, or you would be sent to jail, many, many decades ago. So stuff like that happens. Anyway, I don't have a crystal ball. I know central banks are buying gold. Well, that's what I read.
Yeah.
And I also, found it interesting stumbling across some articles reporting on inflation, and we hear people saying that inflation is so difficult to get up, and Jerome Powell has difficulties getting inflation to target, and Christine Lagarde has the same difficulties here in Europe. But when you look at different types of baskets which people actually use, then inflation could be as high as 8% per year right now. It's just, this outdated basket that's being used with a lot of oranges in there. I don't know how many oranges you guys eat. I eat maybe one a week or one every second week. But apparently oranges have a very high weight in the basket. Anyway, interesting times.
Sure. And I think we touched upon this last week, or maybe I'm thinking of a different conversation. But that's one thing I learned also recently, is that the ECB's way of measuring inflation is very different from the Fed. In Europe, we don't include any real weight to housing cost, while in the US there's 40% weight to something they call defined shelter, which is the cost of living. So of course it's easier to some extent to get to the 2% for the Fed than it is for the ECB. So it's, again, as you rightly say, it's the basket of goods that goes into and services that goes into this, and maybe none of them really reflect the true inflation in society. Anyways, that's obviously.
But as as good trend followers, price followers, people who would advocate to others that, the fundamentals of what's going on in this world, the fundamentals that people kind of know about, and the secret fundamentals that no one can really know about, that's all built into the price. So the markets don't need, we wouldn't expect them to pay attention to oranges or a miscalculated government-produced inflation index.
Yeah.
I agree with that. But, sometimes it seems to be these days that a lot of people have on their mind that there could be a major shift in the regime, given that, we've printed so much money, there's so much debt in the world, inflation numbers aren't really moving, geopolitical tension, you name it. I mean, the list is long and everybody has a different list, but, there's kind of like an undercurrent, it seems, and people are worried about some sort of an end game there. Ray Dalio is telling us that, there's a risk of tension between the people, and, the inequalities between, wealthy and poor and all of that. Like, I don't know whether that's happening or not, but if you you go through all of that, I'm not surprised that people are buying gold, physical gold. They don't want to even buy the gold stocks because, that is a more risky position in your portfolio that could be taken away more easily than the physical gold.
Yeah, and all this is feeding into paranoia or dislike of government around, manifested in the U.S. president and Boris Johnson and
Right.
Bitcoin. And so the governments are kind of not allaying these fears by doing all this stuff. And it kind of reminds me of back probably when gold was at its peak. Pretty sure I bought some gold back then and put it away, near its peak. And I read where there were vending machines, I think in the Middle East or somewhere or India, you could go up to a vending machine and buy, gold.
Yeah.
And as you say that, Jerry, I think it is interesting because you rightly point out that there is a lot of discontent towards government and politicians, et cetera, not just in the West, but we see that in the East as well, in Hong Kong, et cetera, et cetera. And although we could say, well, that doesn't necessarily, affect what we do on a day-to-day basis, but I think longer term, this may well manifest itself in the markets when, at whatever point this manifests in change of either leadership or just something that could be a lot worse, where we go from civil unrest to uncivil unrest, so to speak. So yeah, I mean, it is relevant, even though we don't talk about this because this is a podcast dedicated to kind of rules-based investing, et cetera, et cetera. But of course, all of these things that are happening at the moment will end up showing up in the price at some point, and therefore it will become relevant for us, for sure. Moritz, that was a long introduction to kind of your experience this week as a trend follower. Whether it was a good experience or bad experience, we're always eager to find out.
Yeah, we took a little bit of a segue there early on. But I had a good week. So like my trend following system, as I always do, those equity markets, they continue to amaze me. Almost no volatility, just higher and higher and higher and higher. All of us have long positions in equities, I'm pretty sure. And so this has worked really well. Bonds kind of like sit there. Gold, I've already mentioned, made a move higher. I'm long, so that worked out well. The NASDAQ, it's up 40% for this year. Just keeps on going and going. So cutting a long story short, December turns out to be a good month for me. I'm now pretty sure that the year will be a positive one unless something really bad happens next Monday. But let's hope that's not the case. And then we're off to the races again in 2020. But, looking back, I have no reason to be disappointed with the performance of my trend following system. We've had a good first half year. There has been a little bit of a setback, I remember, in the late summer with, the bond markets correcting quite violently. I mean, they had this very, very strong move up in the early summer, which we benefited from, and then this massive move down in the late summer, which cost some money. But other than that, it's a year to be thankful for.
Yeah, and as I said, we might go back and review the year a little bit later in our conversation today. But just picking up on what you just said, Moritz, if anyone wants to listen to what we would define as a very raw and honest account of being a trend follower, they should listen to the episode just after that big bond sell-off. I think they could hear in our voices that it had been a very rough week, and I think you were in particular very honest about your week, Moritz.
and I'm also, I'm pretty sure, I mean, I need to listen to it again, but I probably said that, it feels pretty horrible right here, right now in the moment, as you live there. That I probably also said that, probably in 3 months down the road, it's one for the memory books. And, we look back on the thing and we just very objectively say, well, you know what, bonds went up and then they went down. So what the heck, we've reduced our positions,
absolutely,
and moved on. So it's one of those episodes where you go like, yeah, it's been an interesting time, but there have been so many interesting times, and you just must not take them too personally.
No, and that's exactly what you said. So it is an incredibly. It's been an educational journey this year, I think, for all of us, and hopefully for you, the listener, as well. Anyways, back to the weekly review. I mean, again, I can only echo. I mean, it was a short week in terms of markets. Of course, the festive season has a little trading, especially in Europe, going on. But we did continue the trending behavior we've seen, which actually is resulting in a very strong finish of the trend barometer that I publish every day. It's currently at 70, which is very high, and so it suggests a solid month of December. And indeed, on our side, like you, Moritz, we had a good week. We're having a decent month and a great year, above our average year, I would say. So, nothing to complain about either. In December, the markets that have stood out have, of course, been equities, clearly, but been supported by a few other markets such as natural gas, soybean oil, and the Mexican peso are really the standouts on our side to the upside, and then smaller losses in other markets, but nothing too dramatic. But it's also been a month, I guess, Jerry, or that there has been some activity in the single stocks, and of course with equities being such in focus, it's always interesting to hear how your models have reacted to that.
Yeah, the equities done well. The indices keep going higher, and some of the stocks that I manage, that I have in my portfolio, they, of course, are going higher as well. Some are sitting there, and that's sort of the downside of trading, hopefully a diverse group of stocks, is that some are sitting there, and some are short or getting knocked out of the longs, but usually only to see them go right back to the highs. So it's kind of a interesting way of looking at the stock market and trying to ignore the market itself and just look at your individual markets that, if I feel like if I've done them correctly, if I've put the portfolio together, they're not all going to look like the S&P, unfortunately, when the S&P's doing pretty darn well. But I agree with, some of the bean oil looks good, and we're starting to see more of the upside breakouts to some commodities, which would be welcome change to the shorts that have kind of a limited downside most of the time. But bean oil and wheat, Chicago wheat made a breakout, nice move up, and bean oil kept going, breaking out of the, maybe the typical correlation pattern of the grains in general. Short a couple of wheats and long Chicago wheat, so some benefit there. And the resumption of the gold and silver looks pretty nice. I don't want to get too ahead of myself, not new highs, but the year-end kind of rally is nice. Platinum keeps going higher, a little bit of volatility there, but and like you said, the Mexican peso, the South Africa currency made a new breakout. Israel, the shekel keeps going higher. Russia, ruble higher. Some of these, the dollar fell a little bit on Friday, so but we had some long positions that keep going higher as well. So it's kind of nice to see that diversification there.
Yeah. So, of course, as mentioned, the markets certainly took a bit of a breather during part of the week. Did people also take a breather from Twitter, Jerry, or did that machine just continue to deliver interesting content over the Christmas holiday?
Yeah, a little bit. Not a lot going on there either. It's been a pretty quiet week. Not sure why. With the Christmas falling on a Wednesday, I think people are done by Friday afternoon for a while. But there was some interesting things out there. Evidently, I thought there was a new book out, but there wasn't a new book. It's a few years old, but I saw some interesting things. I liked quotes from the book itself, Hedge Fund Market Wizards, and I posted some of these things. One of the things that I liked from this book was volatility and risk are not synonymous. Low volatility does not imply low risk, and high volatility does not imply high risk. Selling out of the money options can exhibit low vol, but is at risk of asymptotically increasing losses in the event of a steep sell-off. And then it goes on to say traders will exhibit high volatility because of occasional very large gains, not a factor that most investors would associate with risk or even consider undesirable, but will have strictly curtailed risk because of the asymmetric structure of their trades. Now that is beautiful, wonderful, could not be said better, and it's what I rail about a lot, this vol targeting that assumes that, oh my gosh, this new volatility and this big profitable trade is to be feared, it's evil, we need to get rid of that. But as traditional old school trend followers, I'm totally in favor of letting those profits run, especially if they get scary and crazy and are subject to lots of volatility and drawdown from the peak profit. So what? Keep going, follow your system, follow your exits that have been derived from these past amazing, great trends that are into your rules that say be liberal and be free with your profits, unlike your losses. So I thought this was just a great way to throw back into everyone's face one of my true beliefs, which is let those profits run and be very liberal with those profits and follow your long-term exit stops, and don't be so worried about volatility as long as it's with a profitable trade.
Yes, indeed. Clearly, when you go back through the classics, classical books like The Market Wizards, I mean, you can always pick out some golden nuggets that are really timeless. And I mean, on that note, I'm sure people may have already downloaded from my website, from the Top Traders website, this guide that I have done in the past of some of the best trading investment books, I would call them. But just if you haven't, you should. And if you already done it, you might want to do it again, because I just updated the version. So now it has more than 100 book titles that I think are interesting and useful and valuable. And as Jerry just quoted from one of the books that are featured in that guide, we can always learn from reading and rereading some of these titles for sure.
Well, this another quote from the book that I liked, that I think hits at the heart of what we do and what we believe in, is losing trades can be good trades. There's no way of knowing a priori which individual trade will make money. As long as the trade adheres to a process with a positive edge, it is a good trade, even if it loses. Similar trades repeated multiple times will come out ahead. I mean, that sums it all up. I mean, we do the back test, we follow the process, we are not predicting what the market's going to do, we're just following these trends, and 60% of the trades are losers or thereabouts, and we end up looking at our back test and saying, hey, I have a positive edge. I'm going to do all these trades, and my whole premise is that if I just continue to do these trades multiple times, many times, hundreds and thousands of times, I will come out ahead. So this is what it's all about, and I thought put it together very succinctly, and yeah, I'm a big fan of repeating myself, I guess. This is what we all believe in.
And there's and I like that, because with those good trade, bad trades, or good bads and bad bats, I mean, really they are bats. And there's really good bats, bad bats, winning bats, and losing bats. There's 4 types, right? And a bad bat can be a winning bet, so the outcome is positive, but the process that you applied in order to get into the trade has been bad, and the other way around can be true too. You can make good bets. Good bet is a bet that has a positive edge, but the outcome can be negative. And what you just said about volatility, Jerry, is right there as well. With our edge, we can have so many losing trades, and even subsequent losing trades, that of course will go into a drawdown, and the process itself will only play out with volatility. We can only discover our edge if, like Jerry said, we're reapplying the process many hundreds or even thousands of times, and then over time the edge will show up. But it's such a tiny, rough edge, so crude, that it will be clouded by a lot of volatility over time. And you have to be able to withstand that and embrace that volatility in order to get to the finish line. I mean, I was just thinking about this. It appears to me that there is kind of like a movement in the markets where every year that passes since the global financial crisis, investors want less and less volatility. I mean, hasn't it been the case that 15 or 20 years ago, investors were kind of like okay with 15% vol in their portfolio? Even some institutional investors. Maybe I'm dreaming, but I remember that back in those days, 15% vol was kind of like, okay, I mean, let's do 15 vol. This means markets may go up, 1.5 or 2% on a daily basis. Let's get on with our lives. And this is no longer true. And for a time, it seemed that people wanted 10 vol. But 10 vol now seems to me is high. People want 5. They want 6 or 7. And they do that through risk control, vol control, I don't know what it is. But to me, it seems that this is probably not the right way of going about the markets, is to put on risk and then immediately try stripping away the volatility for like a feel-good investment. That volatility goes somewhere, that risk shows up, you leverage it higher, you go to different parts of the risk curve, whatever it is. There's also the risk that you're not achieving your investment goals. If you're sitting in something that produces 5% vol, how much money do you expect to be making from that investment? And will that really satisfy your targets? I'm not sure. So I'm certainly not in that camp. I'm comfortable with higher levels of volatility. And I think it's, for me, definitely is the right thing to do. It's north of 15%. And I don't have a problem with that. I just need to embrace it. But like I said, it seems to me there is this movement underway where every year that passes, people want lower and lower vol.
Well, not only that, whatever vol, they don't want to see it. So we talked last week, and we can talk again this week about more tweets as concerning that, the hottest thing out there, the biggest bubble out there is private equity, which hides the performance or mischaracterizes performance. The honesty of the accounting is called into question by some. And then, of course, regardless, it's a psychological advantage to sophisticated people who can't understand trend following or don't like it because it's too simple, that they don't want to see performance. So maybe, we could become more desired investment if we could figure out a way to not show performance, not mark to market.
Yeah, I mean, with private equity, we've mentioned it last week, there's the comparative leveraged small cap stocks portfolio, which maybe that portfolio has a vol of 20. Maybe not these days. Maybe these days leveraged small caps are 15 vol. I don't know. But say longer term averages are probably 20 to 25 vol on the leveraged small cap stock portfolio. But private equity investors, they don't see it. They have none of that. They have maybe a quarterly print of the NAV or maybe an annual print of the NAV, right? And if they do the historical vol calculation based on those infrequent net asset value prints, maybe their volatility is 8% or something like that. So it's misrepresentative of the underlying investment that's actually going on. But, there is a risk that even with the infrequent NAV, at some point, the investment will, in the investor's portfolio, realize its natural higher volatility. And this is when all of a sudden the lights go off, private equity stops working because the macroeconomics change or whatever it is, right? And the investment is down 80%. So the next NAV print you get is at 20. The last one was at 100. The next one is at 20. And boom, there you have your volatility in one sweep go, without a chance of getting out. No liquidity, no nothing. You just have to take the 20. That's what you get. You just take it on the chin. There's your vol. There's your risk.
Yeah, I mean, I'm completely fascinated by this topic as well, because I think it incorporates so many facets of investor behavior and biases and the whole behavioral kind of economics you see expressed so well through the never-ending desire to invest in these things that, as Jerry, very well said, mischaracterizes the true risk. So I think we as investors, we want to be deceived by what looks safe, but we still want the high returns, of course. That doesn't change. And for some investors, of course, we know that they need the high returns because they're completely underfunded in some ways. And I think that's so now that we see more and more money pouring into these investments, and you may be right, Moritz, one day we wake up and we get the 20 print instead of the 100, and something blows up. But I worry much more about what that will do to the part of the investment world, meaning, i.e. the pension fund community, where individuals rely on that pension to be there and ideally to have grown. I mean, I can only speak for Switzerland, of course, but in Switzerland, your pension, unless you put it in equities, which you can do to some extent, but not for all of your pension, otherwise it doesn't grow because there is no returns whatsoever to be had. And I worry about when the people who have not had any growth in their pension, and maybe worst case we'll see some pension blow up that might affect them seriously. What will that do to society? How is that going to change some of the core dynamics in society if you see people start losing what they thought was a safe sum of money? And we've already seen, that with this whole negative interest rate environment we've had, where the people who were told in the 70s and the 80s and the 90s and all of that to save money and put it in bonds and all of those things, of course they've had a nice return, don't get me wrong, but now that they have to live from that sum of money, there has been no return if they've stayed in bonds as they were advised to do back in the day. So that has also had a negative effect on that part of the population. I don't think it's a small part of the population either. I think deep down, the people who own stocks are probably a very small percentage of the population at the end of the day.
And it's not a mystery. I mean, these stocks are going to go. These private equity investments are going to go down when the stock market goes down. I mean, they're highly correlated. Maybe more correlated. Maybe 50, I mean, what did small stocks do in 2008? More than the 50% drawdown, probably. Yeah, so it's no mystery. They're just temporarily off the books. Less fall. It's silly because it's so elementary and juvenile and immature. And that's what's amazing by it. We're talking to the same people. You guys are very simplistic. No, I cannot do that with my degrees and my experience and the boardroom I have to listen to. We're pouring it all into private equity. Seriously, the same people. Yeah, same people. Because I'm too emotional. I can't handle the fall. And so you walk in and you say, hey, a CTA walks in and says, hey, I can give you no cost to you. It's there's no opportunity cost. This risk I'm going to reduce is not going anywhere else, but it is. So I'm going to vol target for you. You want 10% vol? Great. Just call me when you want 5. I'll give you that as well. So totally accommodating. You want your real returns hidden? You can have that. I'll give that to you as well. So the managers are complicit in all of this, the CTAs and the private equity. It's all coming home to roost one of these days, in kind of a unfortunate and kind of stupid way that just a normal equity drawdown, that's coming as well. But there's no kind of bad motives behind people who invest in indexes, and they've been told to do that. It has worked, and it probably might continue to work. If you don't know any better, and you don't realize you should have some diversified trend following investments as well.
I was just going to add to that, and we're obviously preaching to the choir. I'm sure a big percentage of you guys listening to our conversation each week, like trend and probably have some trend, but there's also going to be, I believe, a decent proportion of you who don't have any trend following in your portfolio right now, and who may have large exposure to equities. But just following up on what you said, Jerry, two things. One, on top of what you said, the other thing that will be extraordinary is that when the day comes and they find their portfolios deep underwater because of the investments, the decisions they've made, ignoring all of the traditional advice and portfolio theory and all of that stuff which has been out there for decades. The interesting thing is they will be surprised. I mean, they will sound surprised, and it'll make headlines as if they didn't know that they should have done it any otherwise. I think that's one thing. But the other thing, and I said that last week, and I really don't mean to come across in a bad way. But I just don't have much sympathy for people who find themselves in that situation when they know that if you put all your money in one equity in asset class or in illiquid stuff, that it could have very seriously negative consequences. So some people will definitely be upset and so on and so forth, but you have to look at your own actions. And there's been plenty of warning time this time around. There's been plenty of warning, or at least time. I wouldn't say warning, but there's been plenty of time to create a well-diversified portfolio.
It's not that, the information is hidden. I mean, the internet, there's blogs. I mean, everybody, if you're interested in finding out about the risks, then there's ways to do that. There's many books on the topic. I mean, I don't think there's an excuse for an institutional money manager to say kind of like when it then happens, well, I didn't know, or I didn't know better. Everybody had plenty of chance to inform him or herself, right? I sometimes wonder, what role do the consultants play in all of that? I don't work with consultants, so I can't comment specifically. But I mean, those people, ought to be professionals in the financial markets. So are they promoting private equity and venture capital and leveraged small cap stocks and all of that type of stuff to their clients and their advisory function for a fee? Are they making money of that? I don't know. But, I'd expect those consultants to also mention those warnings and say, well, don't become too illiquid. Don't get carried away on all this low volatility investing type of stuff. You may regret it. Like Jerry say, at one point it'll come to roost. And the question is, what do you do then? Are you requesting a bailout? Are you saying it wasn't me?
The other thing, of course, which is quite interesting, speaking, to your point, Moritz, about there's no excuse for not knowing. I mean, since the last financial crisis, one other thing is quite important, actually, and that is the invention of the iPhone, right? I mean, everyone has much more information available, just by using their phone, right? So and a lot of these great people we find on Twitter who really produces amazingly sound and interesting content that Jerry picks up every week. I mean, that's available for free as well. I think the last crisis, because it was a housing bubble, it was maybe more difficult to spot for the ordinary investor. Then I kind of understand that, even though there were some warning signs, but it was tied to, Lehman Brothers and specific events. But this time with the access to information we've had since 2009, it's all there. So this time around, I really don't believe there is any excuse for not having a properly, fully diversified portfolio that can withstand much better the next crisis when it comes, because it will come, even though. And the other thing we maybe forget in this debate is that also it's this passive versus active, right? We nowadays, and that maybe goes to your point, Moritz, about the role of the advisor, the role of the consultant. Everyone is being advised to put money into passively managed funds. But what happens when you do that is you suddenly have a massive amount of money that are not concerned about price, right? Because these funds won't buy things or sell things based on what price it's trading at. They will simply buy and sell based on the flow they see in their fund. So price discoveries, I think, has changed from where it used to be. It's not driven by what is the actual value of what I'm buying. And maybe that's why people like Warren Buffett has more cash in his books than ever before, because maybe there is little value out there at the moment. Who knows?
And, you have hundreds and thousands of people that we don't even know about, but a few we do. Sam, George, Woody, and they're good young men, and they are concerned about their clients, and they read and they make this information available to themselves, and they're like, whoa, If you're concerned about capital preservation and making money, maybe they don't know everything that they'll end up knowing about trends and following prices and diversification, but they're well onto the game and they see the downside of not approaching things by price only and taking small losses and having shorts and commodities and diversification. And so it's not like it's not available to everyone. It's just you have to not have the proper incentives of taking care of clients and taking care of your own money and just being pressured into staying with investments that are continuing to work and staying away from those that don't work. And so there's other factors that keep people away from doing the right thing, but they're not good factors. They're not things to be proud of.
Yeah, and I would say, on top of that, without naming any names, because we don't know if their bosses are listening to our conversation, but as you say, there are people who are certainly trying to make a difference and change the attitudes towards trend for their clients, but are being shut down by their bosses, frankly, because this is thinking a little bit outside the box, and this is not how we normally do things. And so I have a lot of respect and time for these guys who are really trying to make a positive impact and a difference for their clients, despite the fact that they're meeting a lot of resistance within, which may not be good for their personal careers in the short term. But I think you're right, Jerry. I think in the long run, and we know this is going to happen, right? When the crisis comes and when it all falls out, and I'm hoping, but I'm also expecting that we'll see some of these strategies that we work with yet again do well during a longer term crisis. And we know what's going to happen. And then we're going to see massive inflows into the industry again, like we saw in 2009, like we saw in 2003. But it's probably too late, at least in the short term. It's never too late, of course, but in the short term, it's too late. They didn't get the benefit they really needed. But that's another trait of human behavior, I guess. So, yeah. What else, Jerry, did you see on your side? I know we have a comment, actually, or maybe some questions coming from Woody this week. I have another question from William, but I want to let you run with it for now, Jerry.
Well, just to finish up on this, my last quote from this book was, equating manager performance in a given year with manager skill can be a mistake. Sometimes more skilled managers will underperform. The best performers are often the most imprudent rather than the most skilled. Past performance can sometimes even be an inverse indicator. So it's back to the following this process. Did you follow the process? Which has got to be our bottom line. And, even though the risk-taking has gotten lower and lower to preserve management fees and preserve AUM, risk-taking can be out of control and crazy. I've done it myself. So there is a line that you don't want to cross, that your customer, your investors, and it will be difficult to stay in business and, if you're frequently having losing periods of 40 or 50 or 60%. So but following that particular process, and that's back to what we know works, and the process can look, for a skilled person, they're not always going to finish in first place by following the rules and trading with a moderate leverage.
Yeah, very true. Very true. Performance chasing will probably never go out of fashion, though. So, but you're right. Do you want to take the lead on we had a long email from Woody. I only saw it as we started recording today. So if you have a better grasp on some of the points that he's making, then maybe that's a good way to start, and then we can talk about William's question afterwards.
Sure. I think Woody brings up a good point. He's very intelligent, smart, and understands trend and diversification. And but this is a question and a comment that we hear a lot, and he gets really into it with some good examples as to why do trend followers and CTAs continue to say that they don't make predictions when, of course, everyone is making a prediction. If you put a trade on, you are kind of predicting. He goes on to give his reasons, and I guess my idea is I'm going to stick with that we're not really predicting. we're not good at predicting, for one thing. So, like I said, most of us are in the 40% range as it relates to winning trades. So that seemingly might be enough for people to say, "Oh, okay, I got it. You're not good at predicting, so I guess you're not really predicting." And your predictions, if you were kind of banking on those, you would need to be in the 50 point something percent range, I suppose. And so, but I guess it could still be construed that maybe we're taking these positions, we are sort of predicting something. And I think what we're kind of predicting is, and I think he gets into it a little bit, is that what we believe the trend following and the back testing and the edge that we have of taking small losses and letting profits run will continue to work. Okay, guilty. I definitely think that that's the case. We're definitely thinking that the systematic approach that we utilize is, I guess we're kind of predicting it's going to work. We're assuming it's going to work. We're hoping that's going to work, and that all the trades in the past that have, shown us that when we add them all up, they've shown us that we do make money, that we're hoping that's going to continue in the future. I've just sort of, maybe this is not a great analogy, but I think it has, I love. So we're going to talk to Andreas Cleno soon, and I can't wait to tell him how much I love characterizing trend following and trend following trades as bets. Oh gosh, I'm never going to back off that. So we're going to have a really nice discussion about betting. And I think in the same way that we put these bets on, it's similar to a blackjack table where we're sitting there and we have our process, we have our system, we have our rules, but we're not predicting which cards are going to come next. That's irrelevant and silly. And so I have no idea which trades are going to work, and most of them are not going to work. And what works is holding on to them for a long period of time and participating in these outlier moves. And what works in blackjack is the process and following those rules, but without regard to predicting which hand I'm going to win or which cards are going to be next. So it's an okay way, and it's an acceptable way if you want to call it predicting, but it's a far cry from predicting macro events in the future.
Yeah, I mean, I'd love to hear Moritz's view, but I mean, I look at it slightly differently, Woody. I'm not sure I would use the word predicting. I think, first of all, I think you could say perhaps that when we enter a trade, we're guessing. When we exit a trade, we know, meaning we don't really have a clue other than there's a breakout, so we guess and we go long or short. But when we get stopped out, we kind of know that that wasn't a trend, at least for now. So that's one thing I would say about the way I think about this. The other thing is that the reason I don't think we are predicting, I think we do something different. I think we rely not necessarily on that trend following works, but I think we rely, and I have to be really careful now because as an average student in school, I probably didn't pay enough attention to physics. But I think Newton once said in one of his laws that things that are in motion are more likely to continue to be in motion or in that direction until something, externally forces it to change course. So maybe we can't transfer that directly to the markets, but I think there's something to it. I think if you look at the probability of things going up, if they're already in an uptrend, is probably higher mathematically or statistically than not. So I think that's what we're relying on, that some of these rules continue to work, or some of these laws or physics laws or whatever you would define it. So I agree with Jerry. I don't think we predict anything, but we certainly rely on certain things continuing to work without a doubt. But every time we enter a trade, I think it's just an educated guess. But I think when we get out, it's because, our homework shows us that this really wasn't a trend. So I think that's more, we have more certainty when we get out, to put it that way. Moritz, how do you think about these things that Woody brings up?
Like you, I think about, I'm placing all those bets, all those markets, all those positions, long and short. I'm not even predicting their outcome. I don't know what the outcome of those trades is going to be. So I'm not predicting anything about my trend following system, but the way I see it is right now, today, I have a body of evidence and reason to assume that placing those bets is a good thing to do, statistically speaking. And that if my backtest and all the observations that I've made in history acting in the same way to price information produces an edge, and like I say, right now I have reason to assume that that edge is there, and therefore I have to place those bets in order to make money off it. This is how I see it. We may have a completely different conversation about this in, say, if we had 10 years of negative performance, every single year of those down with our trend following trading systems, say down 15% every year for the next 10 years. Will I then have reason to assume that placing those bets is the right thing to do? Well, probably not then with that current system setup. But, I haven't had those years. We're not in that environment. I'm actually having a good year this year. So, and the long-term performance of my system is good. So seems to suggest that placing these bets in the way I place them is an okay thing to do. It's a safe thing to do for me and my portfolio. So I continue doing it. Prediction? Nah, I'm not predicting that the next bet is going to work, and I'm not predicting that my system is going to work in 2020. But the long-term edge should be there right now.
And, back to what he was saying, you're kind of predicting that your system, behavioral biases that are incorporated into your approach are going to continue to work. Well, unlike a trading idea, this is also something that the client is actively predicting as well. So I may keep my trading ideas secret, whether it's global macro or fundamental or value or trend, but at least in that particular idea that, I'll let you off the hook on these other things, but not on this idea that you're predicting that what you have done in the past is going to continue. Well, that information is readily available to all clients. And recently they've been mostly predicting that it's not going to continue. So they're fully aware of, and they're the ones who are really driving that particular bet as it relates to our AUM and lack of AUM. And one of the things I've said over the years is that, something like I have no idea what's going to happen, in the future. Because people will ask me, like I'll have friends who are interested in the gold market or the stock market and stuff. And I'll say, look, I really can't tell you what's going to happen in the future, but I can tell you what the right position is. Right now, the position is, whatever my system has been reflected in my system and the rules and these systems that I trade that have this historical edge. I'm trading different systems. Oh my gosh, I have so little conviction on this particular trade. I even think it's sort of random that system 1 is long and system 2 is short. Or if it's a big trend like a palladium, let's say, or the bond markets when they sold off, I had system 1 got out of some and system 2 stayed long. And so I have so little conviction on this particular trade that I even have two different systems that can contradict themselves. This bond trade, this bean oil trade, this gold exit, where I'm going to get out of these big trends, they're not even determined by the past things that have happened in those markets. My gold exit and my bond exits are the accumulation of all the trades. And so looking back historically on where my exit is for the 10-year might be a pretty bad place and a bad rule to use for the 10-year if you just looked at what the 10-year price action has been over the past 30 years. So I'm using the commodities are impacting where I'm going to get out of my 10-year trade. So, everything we do is we don't believe in prediction and how this trade, we have no idea how this trade's going to work out. Once again, if we follow this process multiple times, thousands of times, multiple, such a small word compared to thousands of times in the future, like we have in the past, we think this edge might continue. Might continue.
Yes.
Yeah. And again, not to split hairs, because we may it may have the same meaning for you, Woody, but I would say again, not necessarily predicting anything, but in terms of relying on human behavior not to change, relying on humans making the same stupid mistakes and decisions that we've done in the past hundreds, thousands of years. Yeah, now that I think we do rely on, and I don't think there's any way around that. I don't think we predict much, but definitely heavily rely on these things not changing. But even if they did, I mean, let's not forget that trend following and the way we trade is adaptive. So we're not relying on it happening exactly the same way as it did in the past. And as Jerry said, using different models and using universal parameter sets, I think our level of prediction and reliance on certain specific outcomes is quite low. But the fact that human behavior will continue to persist, I think we're definitely banking on that.
And what kind of decisions are these? These are the most mature and adult decisions possible. So even if we don't get it right, the decision to diversify, massively diversify as much as possible in all the different markets we could possibly fit into the portfolio with longs and shorts, using price, taking small losses. Where does this fit into the responsibility? I think it's pretty darn good. You failed by being as careful and as concerned about risk as you possibly could be. And this is what adults do. It doesn't matter that putting all your money into an index that can suffer 50 to 90% drawdowns worked out best and beat the more responsible choices. I mean, so what? I mean, it's not like we're doing anything crazy. We're doing the opposite of crazy. We're being the most conservative and the most humble about what we know and what we can think about in the future as you could possibly be. So this is the right...
Adults play by the rules.
Right, and they play by a process. And you raise your children in this particular way to say, look, here's the rules we're going to follow as a family, and here's what we believe in, and you follow those rules. No lying, no cheating, no stealing. Regardless, you may not end ahead. There'll be people passing you all the time. This is how we were all raised, and it's how we raise our children. And this is responsible. And then if someone says, well, what if I don't? It doesn't matter. These are non-negotiable. And taking small losses and paying attention to price and diversifying like crazy, they're non-negotiable. It doesn't matter if it doesn't work in the future. It's the only way to proceed as a responsible, honest, God-fearing adult.
I think maybe the other thing, Woody, why I don't necessarily like the word prediction. I think prediction kind of suggests that you want to be right. But actually, in our case, I don't think we care about being right. I think we care about winning, and winning over the very long run. As I've said in the last few episodes, I mean, who cares if we're down or behind at halftime, right? And halftime could be 20 years if our goal is to have the best possible, sum of wealth 40 years from when we start, when at the time of retirement. I mean, you really shouldn't be concerned what the score is at halftime. So no, given the fact, as Jerry said, we're wrong most of the time when you look at individual trades, I don't think you can say trend followers predict much, if anything. But it's a great point, and I think it's something a lot of people struggle with, understanding how can you make money without making a prediction. I think that inherently is something people who are new to trend following struggles with. Might even keep them from investing in trend following, because how could you possibly make money for 45, 50 years without making a single prediction? Because that's what they do on CNBC and Bloomberg, right? Every day, all the time.
And I just look at my portfolio daily and I just had this big smile on my face. It's just so different. I think, I look at the bean oil and the wheat and the palladium, ruble, and the Mexican peso, and I just think, God, I'm so superior. I just love that. And I just could not imagine, and I'm so thankful that my initial introduction into investing in trading was with commodities and currencies and things that are not, and things other than stocks. oh, I love my stocks, but I'm so happy that I'm so fortunate to be, and I just think, this is, I just enjoy looking at all these different markets and having this diversification. I know it, I feel it, it's real, and it's, it's what I need to be able to sleep at night. And then Woody ends this very nice email by saying, with brotherly love to you all. I mean, what an ending. What a great guy. He's given us the business. He's trying to make us stand up for what we believe and explain ourselves. But he's a very nice gentleman.
Absolutely. And we're very fortunate to have many of those among our listeners. Let's jump to the other question we had this week, which is from William. William writes, question for all three of you guys. Do any of you put any weight in the COT reports that come out every week? For example, in gold, the commercials have a very large short position historically. I am long gold and gold stocks due to my system being long. Would you guys just consider this more fundamentals and ignore it and just keep following price to the stop is hit, or perhaps lighten up your positions if you are long? Now, let's start with you, Moritz. I kind of have a feeling where this is going.
Let's see if your feeling's right. But I guess my answer to that one's really quick. I don't look at the COT report. I really never did. Sometimes I snap it up and there's, things reported on Bloomberg on the news feed and, some number coming out and that it's supposed to be bullish or bearish for the market. And it's kind of like, yeah, okay, well, whatever. But no, I don't incorporate it. I use price only, and that is good enough for me. I believe that any information that is in any COT report is reflected and implied in the price. So you can say that, I'm implicitly using all the information, including the COT report information in my trading, but specifically I do not use any information from those reports.
But let me pose a question to you, though, because of course we knew that was going to be your answer. But let me pose a question to you, because there's a lot of debate and talk, certainly in 2019, about alternative data, right? So do you think it could be used constructively? I mean, could you take this kind of data, create rules that could be useful? I'm not necessarily saying that you would do it, but there is a difference between looking at a report and willy-nilly saying, oh, I'm going to lighten up because this chart shows me that whatever. Or you could do, analysis and come up with certain rules and put that as a component into your rule set.
Yeah, maybe. And, there are many traders out there trading in different styles and using different types of data and inputs to form positions in the markets or build systems. I'm not saying that I have the only one that's working. Far from it. I think there are many, many better people out there. But, I can only be me. And I like working the way that I work with price data. And I haven't really made any forays into the alternative data space. I don't want to say there is nothing there. But also, like with the machine learning and AI stuff, I'm still sitting there and saying, they show me the proof. All of us done Chesapeake. There's proof in the pudding. Look at your numbers. Look at your disclosure documents, and you can see it as a fact, black on white, what the returns of a trend-following trading system have been applied for decades. We don't have that data for the machine learning, AI, or alternative data funds. So show me the proof. Show me how it's working, how you can systematize the approach, and how much edge is in there. Then we can have a conversation. Until then, it's in the stars.
Yeah, I doubt if you can improve upon a systematic approach. However, I'm not against, I've laid out this many times how, if you have this mega profit and it's gone up for 2 years and it's really volatile, and, I think if you want to take some profit off the table and you look at commitment of traders and it says, wow, there's a lot of longs, whatever, it's probably okay to take some money off the table and have some fun and kind of have some contrary opinion. rules in place that you implement maybe once every year or two or three. And so the opposite of a large sample size, it's just kind of like mixing it up and taking something off the table when the market gets crazy or volatile or too one-sided, and you start getting phone calls from friends about their palladium position. Maybe you can go look and find a reason to get out of a little bit of it, just to enjoy life and have some fun and sleep at night.
Sure. All right, let me just do a quick review of where we stand in terms of some of these CTA indices. The last update for the year, of course, it's not the end numbers for the year. And then when I've done that, why don't we do a little bit of a review of 2019, just things that might have stood out for us individually. Nothing we've prepared, I would say, pretty improvised, but just since it is the last episode before we finish 2019, maybe it could be interesting for our listeners what we remember, at least with short notice, so to speak. But anyways, these numbers are as usual as of Thursday evening. Not much, of course, in terms of the holiday season, so some markets had already been closed for a few days. I think Friday all markets were open again, and I think Friday was a good day in general for the CTA world. So these numbers are probably on the low side. But anyways, nevertheless, the BTOP 50 index was pretty flat for the month of December, now down 7 basis points and up 7.01% for the year. The SocGen CTA index down 32 basis points in December and up 6.59 for the year. SocGen trend index down 0.38% for the month of December, up 9.42 for the year, so having a great year. And the SocGen short-term traders index down 10 basis points and up 3.3% for the year. And finally, the Bridge Alternatives index down 1.39% for the month of December, up 8.08. But I have a good feeling that a lot of these numbers are in fact positive for December once we include Friday. So let me throw out just a fun fact that I was looking at while we were recording, coming through Twitter. Apparently, the last decade in terms of individual kind of, I guess, investment / stocks that had done well, the overall winner by a huge margin in terms of performance over the last decade is Bitcoin. And number 2 is Ethereum. Once we move down into the stock world, the next one taking third place is Netflix. And then the fourth place probably surprised me, according to this, is Domino's Pizza.
Yummy.
I guess that goes with Netflix, doesn't it? If you're watching a movie, you want a pizza to go with it. Maybe there's a link there.
Exactly.
Correlation. It's all about correlation, right?
Well, one of the things you were talking about before we went on was some movements. I think maybe it was hogs and then we talked about Bitcoin being a big mover. And I know I bought Bitcoin and lost money in Bitcoin. And I think I was surprised when Moritz said it's up, I don't know how many percent, because it started the year at 3,000 or
91.
Yeah, 91. So it's interesting that we're going to make a lot of money when the trends are big in stocks and in palladium and emissions and things like that. Okay, so we have a big trend. The CTAs make money. The trend followers make money. But our performance can look a lot different comparing to buy and hold. And then, of course, the big, huge percentage moves in some of these markets mean nothing to us because we size based upon inversely to the vol. So something that's moving around 2 or 3% a day, typically, I'm going to have a very small position. And something that barely moved in 2019 might be my biggest winning trade because the vol was really low.
Yeah, absolutely. What about you, Moritz, if we just kind of do the round? What kind of stood out for you? I know we haven't kind of prepared anything formally, but is there anything when you think back on 2019 that kind of stood out for you?
I think, Bitcoin is this ultimate diversifier. I really came to like it in a portfolio context, just, to mention it again real quickly. But I've also observed in 2019 that I there's increased volume in the futures markets on the CME, so there's more trading activity. Maybe some people are embracing it as a real diversifier in their trading strategies, which I think it is. Of course, it is extremely violent. I remember us being in New York City, and within, 24 hours or something like this, the market moved down 30%, up 30% or something like that. So it's very difficult to, stay in your positions. And you may get, tossed around. But that being said, the diversification of that instrument is great, and I don't think there's any reason to not trade it in a systematic trend-following portfolio. We've mentioned the bonds already. The bonds have been great this year. They are, by the way, the largest P&L contributor to my portfolio this year again. It's the gift that keeps on giving. I know the last couple of months have been a bit more difficult with the bonds, but the first half of the year and then the early summer, oh my goodness, there's been a lot of money in those markets. And when you look, when I step back from the computer and you look at all the markets, you may say, well, probably you've made most of the money in equities, but no, equities is number 2, bonds is number 1. Of course, this has to do with sizing. Our position sizes are larger in the bonds, and the trend at the beginning of the year has just been a lot stronger. Now the equity trend is stronger, but bonds again, that's what I look back on.
What about when you look at I don't know if you have this data available now, but when you look at individual markets, forget about sectors, individual markets, what were the big outliers performance-wise, positive, negative for you specifically?
The long-dated bonds, I made a lot of money from those. So it's the 30-year German, the 30-year US. Those have been really good for me.
Okay.
I made money on silver and gold actually quite significantly. And on the downside, let's see, what do I remember there? I, for one, didn't have a good year in the energies. The energy markets have been really difficult for me to trade, with a lot of chopping around. Didn't identify really any clear trends in most of those markets. And so they haven't been that great. Heating oil, for instance.
Yeah. Interesting. What about you, Jerry? What stood out?
Well, definitely staying away from energies is a help. I think whenever you have these massive, crazy moves like we saw at the end of last year, it's just, to me, a signal of, okay, we have 6 months to a year of nothing. So once we wring out that crazy volatility and price movement, and we'll just settle in here. And the vol is sort of low, and energies are rallying now quietly. People have been chopped up, and they've been kind of beaten up by those markets. So now is the time to kind of get interested. I think in general, energy is just something that people can't stay away from. The fundamental crowd wants to get long at the lows, and it's a big component of the economies. And so I think, but it's been fun trading some of the individual equities. Had a huge move in Target one day, and then huge loss in Dollar Tree one day. Short Tesla once this year, and then a few weeks later, long Tesla. So no opinion, just following the trends, buying the breakouts. And it's just kind of funny in the context of how we look at the markets, then especially as it relates to equities, there's lots of stuff written about why and when and where, what's going to occur. And we just sit back and kind of chuckle a little, and that, when it goes lower and hits my exit, I'll get out. But the rest of the world is like, what? What are you doing? Why are you saying that? And so just kind of funny thinking about it in those terms. But, it's trading a lot of interesting equities, fun names that companies that are doing crazy stuff, Spotify or Beyond Meat, Canopy Growth, the marijuana stocks. It's fun and it's different. And in the same way that I like and enjoy, one of the few people on the planet, relatively speaking, to be long bean oil and platinum and wheat and palladium, and maybe getting along cattle soon. It's fun trading some of these different stocks as well. The world is your oyster. You can pick whichever ones you want. we're compelled to trade the currencies or the commodities. We all trade the same ones, blah, blah, blah. But get out there and use some of your creativity and choose the 20 or 30 stocks that you're going to trade and try to find as much diversification as you possibly can. It's so much fun.
Absolutely. Absolutely. I mean, I think for me, one of the things that did stand out was just the unusual run of positive monthly returns that our industry and that we as a firm delivered this year. I mean, on our side, we had 7 monthly positive returns in a row. That doesn't happen very often in the trend following world. So that was a little bit unusual. I certainly also remember the bond sell-off, not least from that weekly episode we did that week. I think it was just so raw and so honest in terms of how we discussed the pain that had been inflicted for a while, but also the optimism about how this will just go down as another week when we look back at it. And I think that was a great point that Moritz made earlier today and reminded us that that's exactly how we look at that week today. 3 months later, it was just another week. So I think that's a great lesson to be reminded of once in a while. I also think about some of the crazy moves we've seen in the markets, like the lean hogs in March and April. I think one of the months where it was up 75%. I mean, we were on the wrong side of that trade. Unfortunately, it didn't cost a lot of money, maybe 1.5% or so. So not a big thing. Would have been great to be on the right side of it, but again, it just shows you, that there's definitely a lot of opportunity out there, and if you can embrace a process, if you can learn to love it despite all its shortcomings, as you say, Jerry, that the world is our oyster, and we can, we should look at the future as being very bright, frankly, when it comes to the opportunity set we have ahead of us, despite the fact that I can't ignore that it has been a decade where a lot of people will say that trend followers struggled to deliver. So again, I don't look at it in those terms necessarily, because I think all strategies go through decades where they have lower than normal performance. We know that that's what happened to equities from 2000 to 2010. Maybe it happened to us from 2010 to 2020. It doesn't mean that money weren't made. I mean, I think the three of us can be proud looking in the eyes of our investors of what we delivered in the past decade. But that's just the way the investment world works, and that's why you need to be diversified. So those are the things that I think back on in terms of specific markets that stood out for us. I mean, the 10-year German Bund was the market that at the moment, with a couple of days left of the year, is still slightly ahead. But and of course, fixed income in general did fine, did really well. But even, gold was a pretty good market for us. The euro was a pretty good market. So lots of opportunities when you trade a diversified portfolio.
At the time when we talked about, I'm so excited to add Bitcoin, and as the world changes and as things go crazy and we see things that have never happened again, we're going to get a few Bitcoins, but we're going to get a lot of stuff in stocks. It's going to be a lot of stuff that you can only manifest it if you trade single names. So it's very important for CTAs to stay on that and to always be offering more and the latest and the greatest and the new fundamental that we can ride as far as trends go. If nothing happens, we take a small loss. But with Bitcoin, I was especially excited to trade that. How are you going to trade it? What's it going to do? How are you going to put it in your portfolio? And it's just an afterthought. There's liquidity. I know when it opens. I know when it closes. I know the tick value. I'm going to trade it, just like I trade everything else. And then at the time, I remember tweeting something along the lines of, what a perfect market, because no one understands it really. No one knows what it's going to do. And so you're not even tempted to use anything other than trend. And so oh, well, unlike some of the first times I've traded markets over the years, the Italian bonds or natural gas, there were instant huge profits for me. The very first time I traded those markets, Bitcoin, it was a loss, but I loved it still. And still, one of these days, it's going to be the calling card for some year where how did you make money? Just like in 19, it was the bonds. And one of these years, it might be crypto. Who knows?
Absolutely. Any other things you want to bring up? I've got a final afterthought, but any other things you want to bring up?
I found another tweet I could just mention. I thought was pretty interesting. It's kind of short. This was written by a stock guy, and he goes, what investment factors work for stocks? And he says, momentum is perhaps the most persistent of all factors, occurring across all investment assets. But momentum stocks shed 20% of excess returns from mid-08 to 09. And he ends by saying, when this approach fails, it really fails. So then he goes on in the article and says, if momentum is not more dangerous and is widely known, why does it generate extra profits? And I think he answered his question earlier by saying, when this approach fails, it really fails. And I think we need to love our losses and embrace those drawdowns and embrace the characteristics that the profitable systems exhibit, which is lots of volatility with big profitable trades. And are you going to be tough enough to hang in there, follow your systems, and not get out and not be tempted to be afraid of the results that you're going to get by purely following these systems?
Absolutely. With those words, I think that's it for this week, for this month, and for this year, and even decade, so to speak, in terms of the Systematic Investor series. Next time you hear from us, it'll be 2020. 2019 was a good year. I think we managed to put out a new episode each week. We held our first live event in New York, and we were honored to be joined by a lot of new listeners during 2019. So I want to express our deep gratitude to all of you who tune in every week, who take time to send us your questions, who likes and share our social media posts, and who offer us ideas and advice on how we can continue to expand this podcast series so we can serve more investors in the future. For us, it's all about sharing without expecting anything in return, but rest assured that all of your kind messages, your emails, your ratings, your review, not only get read, but also are greatly appreciated by the three of us. So from Jerry, Moritz, and me, thank you so much again for spending part of your day with us. We are grateful for your support, and we can't wait to be back with you in 2020. And in the meantime, we wish all of you a happy new year.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll